The turtle traders have legendary status in the financial world as they overcame great challenges to find incredible success. Their journey is one of the most remarkable and legendary stock market stories of all time, as they averaged a compounded rate of 80% per year over 4 years. In the first part, we'll look at the amazing background story behind the turtles, and the second part we'll discover secrets from the strategy. The second part will include a deep dive into their strategy's entry, exit, and risk management plan. Richard Dennis and his partner William Eckhart made the turtle traders. Richard Dennis began his career in the Chicago Mercantile Exchange and rapidly became a millionaire by the age of 26. As his reputation grew, he became known as the Prince of the Pit. Dennis was a very successful trader in the 1980s, as they made around $80 million, which is worth around triple that amount today. The type of money he made put him in the same bracket as the likes of George Soros, who was making around $100 million at the time. He started with $5,000 and eventually turned it into more than $100 million. Following his great success, Dennis and Eckhart had a debate about whether anyone could be taught to trade the futures market. Dennis believed anyone could be taught to achieve what he did. However, Eckhart thought Dennis had a unique skill with trading that couldn't be taught. To settle the debate, Dennis set up an experiment to find a group of people to teach trading and then give them money to trade with. Dennis was so confident in his view that he gave the novice traders his own money to trade with. The training lasted for 2 weeks and would be repeated if any of the traders needed more help. The students were called turtles because he was amazed by the speed and quality at which the turtle farmers in Singapore would grow their turtles. But there was a problem. How do we find the novice traders who would be suitable for the role? To solve the problem, Dennis advertised the role in the Wall Street Journal and thousands applied to learn. Dennis would have to filter through the applicants by interviewing them with a series of true or false questions related to trading to make sure they had basic knowledge. Some of the questions Dennis used are shown here. The big money in trading is made when one can get long at lows after a big downtrend. It is not helpful to watch every quote in the markets one trades. Other people's opinions of the markets are good to follow. The successful applicants included both men and women from a wide range of professions, including an accountant, a teacher, and also somebody unemployed. He would teach them for 2 weeks based on the trend-following system he had used successfully in the past. The turtles would have access to their trading capital for a month, and they could trade up to 12 contracts per market, but they had to stick to his trading rules. Following the success of the initial batch of traders, Dennis put up another ad in 1984, which resulted in him hiring 20 traders in total for a trial period. Surprisingly, he was still left with 13 traders at the end of the trial period, which highlighted the effectiveness of their training and strategy. Part 2. Secrets behind the strategy. The turtles traded highly liquid markets, including commodities, metals, bonds, and the S&P 500. They used a simple entry based on channel breakouts taught by Richard Donklin. 2 systems were used. System 1 was a short-term breakout entry based on a 20-day breakout, while System 2 was based on a longer-term breakout from the 55-day breakout. The main principle behind the strategy was to follow the trend by buying upside breakouts and selling downside breakouts. For example, upside breakouts would occur after the price closed above a 4-week high as shown here. Winning positions could be added up to 4 entries at the maximum. The traders were taught to enter on every signal, as missing one may result in missing a large profit. Even if the market opened with a gap, traders were instructed to enter if the price opened through the price of the breakout entry. The exit for System 1 was based on whether the price closed before the 10-day low for long positions and a 10-day high for short positions. System 2 was a 20-day low for longs and a 20-day high for short positions. However, the rules for each trade setup, entry, and exit criteria would vary depending on the setup and market environment. A key lesson was to never exit a trade too early, as it can significantly impact the profits for the trend-following systems in particular. The aim of the strategy was to have far more losses than winners. However, the winners would be significantly larger. Also, the exact criteria remains protected. However, the book The Complete Turtle Trader by Michael Covell gives interesting information around the rules and principles of the strategy. Here are some key examples from the book. Firstly, focus on market analysis rather than on information from the media when making decisions. Use discretion with criteria for buying and selling based on what works well for different markets based on your experience. Set your take profit target and stop loss before entering a trade. Knowing where you'll cut losses helps you understand how much money you'll want to risk for the trade. Another tip was to place limit orders most of the time instead of market orders because it gave better entries. Additionally, limit orders would help avoid slippage compared to market orders. Risk management was a key part of the turtle trading system, as traders were told to set stop losses before entering a trade. Interestingly, stop-loss sizes could be adapted to the volatility of the market, where larger, more volatile markets had wider stops. By setting a set amount of risk in advance, they aim to protect capital and avoid major losses. As the saying goes, there are old traders and bold traders, but no bold old traders. The turtles use a position sizing algorithm based on market volatility. To help calculate the volatility of a market, they use the 20-day exponential moving average of the true range. They used units to determine their position sizing while factoring in the risk of a position and the risk related to the entire portfolio. Using modern trading software such as TradingView, we can apply the average true range indicator to help see market volatility. Greater position sizes can be taken in lower volatility markets and less risk in higher volatility markets. A few other key points regarding their risk management were to never risk over 2% of the account for any trade and to make more profit. Be prepared for large drawdowns. So, did the strategy work? It's fair to say that the turtle strategy turned out to be an incredible success, as the two groups that Dennis taught claimed to have made over $175 million in 5 years, according to former turtles. The turtles still say the system still works, and individuals can apply the rules to their own trading strategy. The major downside to the turtle strategy is that it's expected to have a low win rate, usually between 40 and 50%. Most trend-following strategies tend to have lower win rates, as most breakouts are false. However, the winning trades are often far greater than the losing trades. Next, we'll move on to look at the key strengths and weaknesses of the strategy. The incredible turtle trader story gives hope to any novice to have great success from trading using a clear set of rules. It's essential to be disciplined and stick to the rules, especially during periods of drawdown. The mechanical approach helped remove emotion and personal judgment from trading decisions. The traders, or turtles, were taught to follow strict rules, including which markets to trade, how to size positions based on volatility, and how to use entry criteria to avoid missing out on big opportunities. The system was mechanical and helped the traders to not let their own judgment interfere with decisions. A major strength of the system was its ability to catch big winners by using predefined exit points, such as a 10-day low for long positions and a 20-day high for shorts. Despite the success of the experiment, it revealed the difficulty for traders sticking to rules over the long term. Some students failed to follow the rules strictly and allowed emotions and doubt to take over. The experiment emphasized the importance of discipline, especially during long losing periods, which can easily cause emotional fatigue. Another downside to the experiment is that the turtle system excelled in trending markets but struggled in range-bound or sideways markets. There are times when a market doesn't trend for many months, leading to a significant account drawdown. How would you feel after 1, 2, or 3 months without any profit? Most breakouts don't result in setting a new trend. The traders had to accept more losses than winners. However, the winners were considerably greater. Nonetheless, taking on far more losses than wins can be very challenging mentally. A key takeaway from the turtle trader experiment is that it helps most traders to have clear rules for entries, exits, and position sizing. The primary reason is because as emotional beings, we are likely at some stage to overtrade and take on too much risk due to greed, overconfidence, or fear of missing out. Sticking to rules can help many traders overcome emotional bias with trade setups and lead them to a more consistent path to profit from the markets. This leads us to the second major takeaway, which is that while it's valuable to have trading rules, it's also tough for most traders to stick to them. Many decide to disregard rules or edit them as a result of our emotions toward the market and our past performance. The fact that the rules had been developed by some of the world's most successful traders definitely helped the novice turtles stick to them. The importance of understanding your psychology with trading cannot be underestimated, as it's a major factor in determining success. Simply knowing rules is not enough to make anyone a successful trader, as you must be able to follow them. Richard Dennis once said, "Almost anybody can make up a list of rules that is 80% as good as what we taught. What they couldn't do is give the confidence to stick to those rules even when things are going bad." Hey, let me know in the comments which part of the turtle story you found most interesting, and if you would like me to explain anything more in detail. Check out this video for more tips on how to find large gains from stocks, according to Warren Buffett. Also, please consider subscribing and clicking that like button because it helps. Cheers!